Good morning, ladies and gentlemen, and welcome to the show. Glad to have you here on this 14th, Tuesday, the 14th of November, 2023. Thank you for tuning in. Now, let's look in there and take a look at what's going on. The headline CPI, as you can see, massive money printing up until it reached a point. Inflation is lagging a little bit. The money printing comes first, then comes the inflation. Peaked at over 8%, up around 9% here, as you can see, and we've seen a sharp decline in the CPI now, and it stands at 3.2% right now, but it's falling rather rapidly. So what's this doing? This headline CPI, how's this affecting the markets and stuff? Yields plunge, stocks soar, dollar tumbles, as Fed hikes are officially over. The countdown to the cuts began. And this is what's happening right now. They can smell the money printer getting ready to start back up again. Perhaps we're not going to have that deflationary spike event. It has to have the right conditions in order for it to happen. Or perhaps we had it in the credit markets and stuff, and maybe they covered it up without us knowing about it. That's more likely. Perhaps that's why we see this shift occurring right now. Now, what's all this leading to? Well, you're going to see in the markets. You can see the reflection of this in the stock market right now. You can see the reflection of this in the silver and gold markets. And we're going to get to that. But first, let's take a look at the world news and see what's going on out there. Ukrainian news. The European Union is struggling to produce and send ammunition it promised to Ukraine. It says European Union nations are acknowledging on Tuesday that they risk failing to provide Ukraine with the ammunition they pledged to help Kiev stave off the Russian invasion and win back its territory. Early this year, EU leaders promised to provide 1 million rounds of ammunition to the Ukraine front line by the spring of next year. But I guess they're having trouble putting it together. I tell you, war in Ukraine's been dragging out for a long time, and I told you the most dangerous part of a war is near the beginning and near the end. That's the most dangerous parts of a conflict. Now, in Israel forces say they've offered incubators for Gaza's main hospital. Looks like a pile of rubble to me. But I'm sure these incubators will be very much appreciated for the babies, but they got to have a power source. A generator can prove as a power source. And they got to have fuel. If there's no electricity in the area. So I hope they remember that they need to have a generator and fuel in order to be able to use them. Now, in other stories here about the finances again, investors haven't been this bullish on bonds since the depth of the great financial crisis. Here's a chart. Here's a chart showing how that March of 2009, it's happening again here. And we can see it in the bond market. Let's just take a quick peek and see what's going on with bonds today. Look at these rates, these yields falling. There's a sudden shift here in the financial markets. And I spotted it this weekend, and I talked about it in one of my shows early this week, that the shift has occurred. And now we're starting to see the evidence of it starting to reflect in the markets. Bond yields are falling quite precipitously. Look at the 10-year. It's fell 17.9 basis points in one day. That's the biggest fall we've seen in a long time. That's a huge fall in yields. What does that mean? Well, for you guys out there, when bond yields go up, it means nobody's buying the bonds and the yields are rising. But the opposite, bond bull market is when yields are falling. That's a bond bull market. See, it works it's the inverse of how normal markets work. Normally, you see the stock market falling, and you say, oh, look, it's crashing. Bonds crash in reverse. When yields rise, bonds are crashing. This is the opposite right here. And look, it's just went up to 18.1. There's been a sea change. It happened on the weekend. It started Monday. Starting to see reflections of it in this sea change. So we're looking at a 10-year at 4.45 and falling. We also see it reflected in the metals. We're going to get to that in just a minute here. Make sure I covered all the stories. Now, silver price today. Look at this. It's up 82 cents right now. This might be, if they start printing again, it will be. We're not quite to that stage yet. Yields start to fall. But, you know, I heard layoffs are beginning all across the country. The country is headed toward deflation. And just look at this. Remember that chart right here? Well, we had that little bounce behind my head there. I'll move my head over a little bit so you guys can see it. Okay. Do you remember we went down to this point right here and everybody says inflation's coming back? Well, it did. It started to come back. But now she's sharply turned down again. See? And so they keep their eye on the CPI, and they keep their eye on especially the Fed keeps their eye on the unemployment numbers. And, you know, I mean, they're terribly scared of deflation. And how much are we above this bottom line right here where it goes down below the zero mark? That's where we enter into deflation. We're not that far above at the speed it's going down. I mean, we could, at that speed, that rate's going down right now, we could see deflation start if they don't do something. And so this shift is in order because they're not going to see deflation. They're not going to allow it. This shift is in order now, and they can see it coming. And this is why this reflection in the markets right now is why they're front running. The market's front running. Just take a look. Look at the Dow Jones today, up 534 points. The market's front running right now. But what they don't realize is, and what I think they're front running the beginning, the entry stage of a hyperinflation. It's called the acceleration phase. It's the lead-in period to a hyperinflation. Now, it's hard to believe that we're talking about hyperinflation here when we're talking the CPI falling off like this and heading toward deflation. It's hard to believe I'm talking about hyperinflation. But you have to realize that generally hyperinflations are triggered by a deflationary period beforehand. And it's the trying to correct that. And I believe that's what happened in Weimar, Germany. Was they get out and they see, it's just like how the markets work is it's like the cure for high oil prices. It's high oil prices because people cut back on use of their oil. And, you know, this is it right here. I mean, the cure for your inflation is deflation, and the cure for deflation is inflation. And it's a balancing act between the two. And on this chart, what you're seeing is the balancing act. Picture a tightrope walker walking across a ravine, you know, and he's balancing himself. To fall off the tightrope is he can fall in 1-2 directions. On one side of him is inflation, on the other side of him is deflation. And so this is kind of trying to keep this in balance. And so their target point is this 2% mark right here. That's their target. If they fall below that target, they're going to start stimulating again. The markets are front-running this. They see this falling below this 2%. We haven't got far to go. We're at 3.2 and it's falling fast. Falls below that 2%, they're going to start to lower rates. Either that or do yield curve control. And or maybe they'll go back to quantitative easing again. And it'll be no more talk of quantitative tightening. And considering how many dollars they've already created, all the money they need for a hyperinflation. That money is secured inside a liquidity trap. It's the biggest liquidity trap the world's ever seen. It's trapped within the banking system. It's trapped in places like, of course, it's been coming out of the reverse repo facility, but that's in the order of trillions. But there's also the somewhat, I think it's 20 trillion that's held by foreign entities that could all come flooding back if they say to themselves, hey, you know, our dollars aren't going to purchase anything. Or if they get mad enough at the dollar and they want to see its demise. Believe me, they do. And I think that they're sitting there waiting. Of course, you know, the Chinese did, I think it was about $20 billion in treasuries a day in the past very short period of time. Anyway, let's move on. We got stuff to talk about here in the markets. And so we're looking at a silver price today that's up 81 cents. Let's check gold. Gold's up too. $18.30 at 1964. What a great year that was. Anything pre-1970. I didn't get to see an awful lot of the pre-1970s, but I can tell you what. It just was a downhill ride from started in about 1980. It was downhill from there. And it hasn't got any better. It's just getting worse and worse all the time. And in the end, it's going to get to the point where it's almost going to be unsurvivable if it keeps going down in this direction. Because I remember the good times. And these are not good times we're living through right now. These are very perilous times. Anyway, not to get sidetracked here, let's take a look at cryptos today and see that Bitcoin is 36,292. It's cooling down just a little bit. Ethereum is at 2048. Taking a look at XRP is at 65.6 cents. The Dow Jones Industrial Average, we did that. It was up 564 points at 34,902. For investors, these might be pretty good times. But they're not going to be good times for the rest of us out here. Because in order to try to cool off this inflation, they have really thrown a monkey wrench into the economy. They said that they were shooting or actually trying to get a recession. What they're actually getting looks more like a depression. And Americans are all going to start to feel the pinch. And there's going to be a lot of complaining pretty soon. People that they have a choice. They can either pay their mortgage or buy food for their kids. And that's what's coming down. And a lot of them are going to lose their jobs completely. What are they going to do? Mass layoffs are beginning. Right now. Taking a look at crude oil. $79.69. It's up $1.43 today. Bonds and rates, we're looking at, well, we already went over this, but it's climbing as we're talking. 18.1 basis points on the 10-year, 4.45. These yields are falling all the way across the board. And finishing up with the dollar index, the dollar's falling rather precipitously today at 104.39. It's actually, it looks like a cliff. Doesn't it? Looks like a cliff. But this might be a good thing. You know? A strong dollar might not be such a good thing, especially for working class people, because when they create a Ponzi scheme and create as many as something that they can, if they use artificial means to support that, then there's extenuating circumstances that come off of those artificial means they use in order to artificially keep the dollar strong. Like, one of the things is the suppression of precious metals, but there's a lot more, and it might have a lot to do with why all of these wars are going on right now. Anyway, thank you guys for listening. Like and subscribe, and you guys have a great afternoon. Bye-bye.